reflects their values. Okay, and also what are the problems so we are going to face in selecting proper prices to value the project costs and benefits, and have a practical approach, so and how to resolve such type of things. Okay, and what is the situation of the future relationship between different prices change and the inflation problem. As you all know very well, price is not a stable factor. Price is always changes from time to time. So and apart from that, the inflation will also so keep on influencing the prices. So how and what type of problems will arise, and what type of issues so which we have to resolve from time and again. So that is the basic issue of the project cost. As you know that, so in general, if the project is delaying, then the cost of price of a project will goes up. So that means that so the marginal value of the product and the opportunity cost, so these two things will grows up. Because of that reason, the pricing of the project will so grows up over a time period. Okay, so these things, so how you are going to explain or how you are going to calculate so from time and again, so these things so are very very important for any type of project which you can take up. Okay, that is why so each and every project has some type of stipulated time period. What is the what are the what is the time which has been allocated to it? As you know that for each crop there is a certain stipulated time period which has been assigned to each and every crop. So after that, so where you are going to sell those products, how you are going to sell it, then at the time of so harvesting, what is the price of it, and so at that time, so you can calculate that, so my production cost and the my the survival sustainability of that so crop is coming or not, those things you can calculate, and accordingly you can try to sell your output. So during that time, the marginal value of the product, marginal value means an additional so product cost. Okay, so how much the additional input output cost is taking place, and then what is the available and the what is the opportunity cost so which is incurred so in the product which you are trying to sell it out. Okay, which is available to you, because it may differ from place to place, person to person, and time to time. These three things will so will play a major role while getting the opportunity cost. Okay, so those things, so today we are going to discuss about it under the prices reflect value. What is the prices reflect value? So this, under the financial and economic analysis, so two basic concepts. There is a mm, marginal product, marginal value of that product, and the opportunity cost. What exactly? Yes. Suppose, so for example, so marginal value of that product, as I have already told you, what is the so when you are trying to calculate the type of any type of product of the output additional output, one if one unit is increasing the your product, then what is that cost? Okay, so that is called the marginal value of that product. Suppose for example, so in wheat or any mustard or any type of crop, so the fertilizer applied and marginal physical product and marginal physical value product of nitrogen in wheat and mustard production. The MPP of nitrogen means the additional output obtained from an additional unit of nitrogen, or marginal value product of nitrogen means the value of the additional output obtained from an additional unit of nitrogen. Okay, so that is what so we have to remember. Marginal value of product is equal to MPP into multiplied by unit price of output. then that is called marginal value of that product. In that sense, suppose for example, so if one unit, so the you are calculating the assuming the price of wheat is suppose 7 rupees per kg, and that of mustard is around so 12 rupees per kg, assuming the price of urea with so 46% nitrogen content, the price of per kg of nitrogen comes, so how much that will comes around 12 rupees. Okay, so it can be observed from the table that the responsiveness of wheat and mustard yield to nitrogen is high at the lower level of nitrogen application, and as more and more nitrogen is applied, the additional yield obtained from each additional kilogram of nitrogen diminishes and ultimately becomes zero and negative thereafter. So this is what, so you have to understand the marginal productivity theory, diminishing marginal productivity theory. As you have any type of knowledge about the microeconomics, so in that we use it to discuss, we use it to explain about the this theory. So if you are so try to produce so the level of output, then additional unit of so input which you are taking to produce so some type of level of output, additional output, then to at what rate so this is going to happen, this is going to increase, this is going to influence. Okay, to some extent it may grow, after that it may comes down, because so your level of satisfaction has reached, once your level of satisfaction is reached, the marginal utility will goes up to your level of satisfaction reaches. Then beyond that also, if you want to add some more so inputs, then the output will goes down. That is called the so the diminishing marginal utility theory, so which we can connect this so marginal value productivity theory. Okay, so this is what the theoretical base. Okay, so first of all, you have to understand what exactly the concept of the marginal value product, additional value of that product, so how it will takes place, and so as a response, so what exactly the your so opportunity cost will also goes up from time and again. That is also very important. Okay, because so when the opportunity cost will arises, so thus whenever you have the scarcity of resources, because you, as you know that the first of all, the resources are very scarce in nature, as you know that, whether it may be land or labor or capital or organization, whatever the so factors of input, so they are very scarce in nature while producing so any type of product. So at that moment, so the opportunity cost so is going to be arises. That is why so this may be arises in several occasions, in several forms. Okay, simple example, for example, so opportunity, when the opportunity will arises, you never know. Okay, then how it will come to you and how you are going to encash so those opportunities, that is also, it is very difficult to predict, and it is very difficult to judge. Okay, during that time, so how much cost you are going to incur, so then what type of returns will come when the when your opportunity cost will be achievable or not. So these are all the problems which are associated so with this type of so product when you are producing. That is what so in the project, while doing the any type of project, so you have to keep it in your mind that if I can add the so additional input, what type of value, marginal value of that product will goes up. And so if you are preparing one type of so level of output or the outcome, so what type of opportunity cost so which is so incurred in that process, those two things will reflect the prices. The prices so will be influenced by these two things. Okay, if you are really in need, then whatever the cost may be, you are going to purchase. So if you don't need immediately, then the goods opportunity cost will also come down. Sometimes, so when if you are in need, then the opportunity cost will goes up. So, or if you are not in need at present, then the opportunity cost of that product will comes down. So in that way, the prices so reflect the in the form of value terms. Okay, so in that way, so in the project analysis, fundamentally you have to remember about the marginal value of that product and the opportunity cost of that product. Okay, then so what are the findings so which you are going to so derive from these so market prices? Because so market prices, as you all know, that how the supply and demand so will be in a position to fix the price so of that level of so input or the output which is available to you. Okay, so that output, whatever the cost it will come, so then you can compare with what type of inputs I have so spent, whether at least that much has in return it has come or not, that you are going to compare it, and then you can see that so how the market prices are so supporting to you. That is the most important thing. Just a minute. బుజ్జి
మీ పేరు మీద గ్యాస్ కనెక్షన్ ఉందా?
నా పేరు మీద లేదుగా.
తీసుకున్నావా ఇక్కడ ఢిల్లీలో?
తీసుకో.
తీసుకోవట్లుతానా లేదా అంటే నేను ఇంక ఇంటికి వెళ్ళిపోదాం అనుకుంటున్నాను.
వచ్చేసాయి అయితే.
మీ ఇక్కడికి వచ్చేనా?
మరి వచ్చేస్తావా అటు వెళ్తావా?
అది మీ ఇష్టం.
ఇటే వచ్చాయి రాదు.
సరే. ఎందుకు ఇంకా ఇక్కడ ఉండటం?
సరే అయితే.
రంగులు వేసేటప్పుడు అవన్నీ తీసి ముందు రెండు గదులు సరి చేయించేసేసి ముందే, ఆ తర్వాత మీ దగ్గరికి వస్తాను నేను.
నా పని చేయి.
మీకు వీలైతే కిటికీలు పెట్టించండి. వీలైతే కింద కిటికీలు పెట్టించండి అంటున్నా.
కింద కిటికీలు ఏంది?
హాలు చిన్న బెడ్రూమ్ కి ఆ కిటికీ జాలి అంతా పూర్తి పోయింది.
జాలి పెట్టించు.
వెనక్కి చేయించి పెట్టించుకోకూడదు మనం, తయారు చేయించి కొత్తకి.
అది ఇటు పెడతాడేమో, రాంబలి పెడతాడేమో, అడుగు వాటికి ఇద్దాం సెపరేట్గా. సరే చూసి అడిగి చెప్పు. సరే నేను క్లాస్లో ఉన్నాను. సరే. Yes, sorry for the inconvenience. Yes, so the how to find out the market prices. So at the point of first sale and farm gate prices, so market prices will change. It depends upon the point of first sale immediately. So the first where you are so selling your output, and at the farm gate prices. So what are the farm gate prices so which are available or which are prevalent? First sale means so is considered as the appropriate price to value the output generated under agricultural projects. That is the first sale. Okay, so how to point of first sale means so appropriate price so to value the output generated under agriculture project. So how much, so what type of output which has been generated out of the agriculture project, so that is the point of first sale. So then for both so that product value is in a competitive market. So how, to what extent this is appropriate for both financial as well as economic analysis, that we have to see. Okay, then the second aspect which we have to see is that so when increasing the agriculture output, price at the point of first sale is the price that the farmer receives at the farm gate. So those two things which we have to see. Okay, primary or secondary market. So primary market means so immediately wherever you have produced, so immediately you want to sell, that is called the primary market. Then the same product which you want to transport to some place, and so in that place, so you are going to sell it out. That is called the secondary market. So these two marketplaces, how much the price is going to be fixed for the type of product which you have produced through the agriculture project. So that is what here we have to see, that point of first sale and the farm gate prices. Okay. So then the pricing intermediate goods. Okay. Intermediate goods means semi-finished, not so totally. So the clear-cut output, so which we can call it as. Okay. The what is the imputed value of the intermediate goods, that we have to see. So these inputs, so if suppose whatever the output which is available through the project of agriculture, that products may be used for some other, so final output, this is called the primary basic output is act as an intermediate good. That is what you have to see. Suppose, for example, there is a paddy, as such you want to sell it out at the first sale or the farm gate prices, that is the final output at that stage. Otherwise, if you want to prepare some type of at the some type of some other product, so to prepare some other product, so through rice, or so through any type of wheat, or so some type of byproduct, or you want to produce some other product, then this the primary output will act as an input for that product. That is called intermediate good. Okay. So at that time, what is the pricing for that intermediate good, that also you have to so decide. How you we have to decide that pricing of that intermediate goods, that is also an important point in the finding of market prices. Okay. Because so you are going to sell the paddy to the rice millers. The rice millers, so they can process it and they can sell to some other agency for some other product. Okay. So in that way, so your final output will become to the miller, so as an intermediate good. So he can process it and he can finally he can come up with some other output. Then he will sell that output. So in that time, so your product will become an intermediate good to the miller, and so the miller, he can process it and he can add some type of value, and so then that type of output price can be so increased, so to some extent, and in that way, so he may gain benefit out of it. In that way, he may sell your output as an intermediate good, he can consider, and accordingly the final output he may prepare and he can sell it out. In that way, so the agriculture output will change its form, and so it can be an intermediate good at the beginning, and then he can process it further as a final product in some other form. So in that is what so in that time, the what exactly the market price will be fixed for that product, so it can be decided by the miller, so who has purchased output from you, so he can fix the price and he can sell his own price. Then some other problems in finding market prices, so are basically, so there are several other problems which we have to see it. Okay. Assessing the value. So suppose, for example, that is what we what there are different type of problems will arise as so finding the market prices. Okay. Because that's what I have already told you in detail. Okay, you are selling your output to the miller, so he it will become an intermediate good. Then he can prepare, he can process it, that product, primary product, into the final or secondary level of output. Then he can have some type of problems. So how to fix that type of price, how to determine that market price, so of that type of intermediate good which he is processing and trying to sell it out. Okay, so then where he is going to sell, whether he is selling at his own firm or at his own factory, or he is also trying to send to some other marketplace. So wherever the demand is there for that type of product. So in that way, so these are all the prices which he can calculate and try to add to that level of output these prices. Then again he will fix it the price and he can sell it out so to in a at a different rate. In that way, these are the, so when he is going to fix such type of prices, then there are some type of problems. So which an entrepreneur or a, so whatever you may call it as, whether he is a businessman or intermediary or so final so producer, final so marketing where it is taking place. So in that places how much so he is in a position to sell your product so in a different manner, that makes so the different value of that product. In that way, how he is so finding out the market price so is also one of the most important typical problem which is so happening when so the market prices which are taking place. So in that way, so these two things so which we can see that, so how this so how you are pricing the so reflected value and how to find out the market prices, these two things so you can try to understand so far. Okay, and then the third aspect which we have to see is that how to predict the future prices. Predicting the future prices, this is a very difficult task. You does not aware that how much demand for the type of particular product which you are producing is going to have value in the market. Okay, so that is what so you have to remember and try to understand how to predict change in relative prices. This is the most important influencing factor while predicting the future prices. Okay, so if you are predicting the future prices, then what are the other prices, relative products prices which are changing from time to time? They will also decide your product value, your final product value. That is what so you have to understand while determining the predicting your future prices. So that you have to estimate what type of changes in relative prices which are taking place. Suppose for example, so there are different type of cereals. So if you are producing one type of cereal and some other persons they are producing some other types of cereals, what type of prices they have in the market, whether so during the period when you are so holding that type of product, if you are not selling your product immediately, or if you are selling your product at the secondary market level during that period, so what type of so prices so which the other relative so commodities, relative so competitive so goods which are in a position to have such type of prices, that can be the most important determinant so in changing the relative prices you have to understand. Then second factor, as you know, it is an usual thing, inflation. How at what rate the prices are so growing up, so that will indicate the inflation. How much percentage of inflation in your products and in other products which are taking place in the market, depending upon these two factors, so you are going to predict how much price it is going to be so in your final product, or so the what are the other products prices which are likely to affect to your product. So these two things will be taken into consideration so while predicting your products future prices. So these are all so important so in the project analysis. Okay, you have to keep it in your mind. Change in, so then prices for internationally traded commodities and export and import parity prices. These two are also influencing your future prices, your product's future prices. So will influence or will be depending upon the prices for internationally traded commodities. Okay, suppose, as you know very well, the grading, the grade A or grade B, grade C, like that. So if you can grade your products, so what is the A grade value of that product at the international market level? So that you have to come to know and try to compare and try to fix, so your product value, how much it is going to be. In that way, so the prices for internationally traded commodities will also influence, so to predict your future prices. Okay, so it may be, sometimes it may be more or sometimes it may be less. So any type of thing may likely to happen, so at any moment. Then finally, the export and import parity prices, that is also an important thing. So what type of things, so you are trying to export, what type of goods you are trying to import instead of it, or say similar type of quantities of the product which you are going to import and you are going to export. So you can compare those things, and so ultimately what is the value which is going to be favored to you, whether the type of product which you have produced, what type of cost you are selling in the market, and what type of output, so at what cost you are trying to import. So the difference between these two, so must be favorable to you, then only so your income levels will be maintained or sustained. Otherwise, so if you are selling your product at the lower cost and at a higher cost, so you are going to import, then there is a large gap between these two goods, import and exports point of view. Then ultimately it is going to a definite loss to the type of organization or the nation which you belongs to. So these things, so which are very very important. So when you are doing this type of project analysis, so pricing of the this output is very very important. So you have to always keep it in your mind in these things. Then the second thing which you have to see, that farm investment analysis. Okay, what is the farm investment analysis, so which we have to think of? This is the second aspect. So far we have discussed about the pricing of project costs, and so what are the benefits and the losses which may come across, so while discussing about these things. When the project analysis point of view, so when you are doing the project costs, pricing the project costs and benefits. So if you are trying to analyze the these costs, so you will come to know that whether the type of products which I am producing is going to be beneficial to me and to my society or to my nation or not. So that is going to be assessed through the pricing of project costs and benefits point of view. Okay, secondly, what are the farm investment analysis? So farm investment analysis on your lands, so to what extent you are going to invest, so how it is going to be analyzed. So these are the main objective of the this analysis, so which we have to see that. So in the farm investment analysis, what is the net benefit increase which we have to see, and what is the unit activity budget ultimately which we are going to assign to the agriculture projects. These two things also which are going to play an important role. Okay, so while doing the financial analysis, what are the important things which you have to remember is that to know the financial impact on project entities. Okay, So you have to see that, suppose so, if there is an agriculture project, so which you are taking up or which you are trying to invest, so or which you are going to estimate the costs. So you first of all you have to know what is the financial impact on the project entities. Okay, to what extent the farmer or so an organization who can invest on the agriculture aspects. And second aspect which we have to see that to assess the efficiency of resource use, how to use the efficiency of resource use. As we all know very well, the first of all the first and foremost objective of each and every resource is the resources can be optimally being utilized. That means so because the resources are very scarce, scarcely available to any type of product. So to what extent so that type of so product so is under the observation, and so how you are going to find out the efficiency of the type of resources so which you are likely to analyze or trying to consider it out. Thirdly, to assess the incentives to the project entities, then that is also most important. What type of incentives the organization is offering so to you, that is also the most important entity of the project. Incentives means some type of benefits, some type of so benefits so which can directly goes to the farmers accounts, or farmers they may get benefit directly so with that type of things, whatever the project entity may be. So if the government or private agencies or some other people they are trying to so influence with their own investment, that will definitely be added an added advantage. Okay, to assess the incentives to the project entities. Then fourthly, to provide provision of some sound financial plan. So if any other organization which is contacting you, you must be streamlined. So within whatever you have in the product, so which you are going to so plan or trying to produce. Then fourth one is to provide provision of a sound financial plan. Okay, how you are going to provide so a provision of sound financial plan, that is very very important. Okay, what is the sound financial plan? So but it means so the it has to maintain some type of balance, so there may not be a huge loss or there may not be a so topmost so beneficial. If the benefits will come without having much losses, then that will be an welcome feature to any type of agriculturist or to any type of farmer. So that is what so which we have to remember about it. Then accordingly, so the sound financial plan he or she can able to prepare. So for that reason. Then the fifthly, the to coordinate the financial contributions. He has to coordinate. So what exactly the financial contributions are existing in it. Okay. Then finally, to assess the financial management competencies. So, how you are going to assess the financial management competence? So, financial management means so whatever the receipts which you are going to receive and what type of expenditure which you are going to put the so on such type of project, you have to see that the financial management competence, to what extent the financial management is in a position to compete with each and other, so every financial aspect, that is most important. In this way, there are the six type of objectives of financial analysis which we are going to discuss about it. Then preparing for the farm investment analysis. So, how you are going to prepare the farm investment analysis? Farm investment analysis is not that much simple. Okay, how much you are going to invest on that farm. Okay, that how you are going to analyze. So analysis, so how you are going to see whether it is a government school or government so institution or the private institution or government project or the private project, so which we have to see that. So how this so farm investments will plan guidelines for preparing farm investment analysis. What are the guidelines so which have been prepared? And so there are different type of farm investment practices which are there. Okay, then mm, in the guidelines, mainly we have to see that what is the pattern of farm investment analysis, whether it includes the farm budgets and farm budget means, as you know, that so you have the expenditure incurred and what are the income which is available. So both the things so go in hand and they have to be balanced at some extent. Okay. And secondly, multiplying the total area to be planted by the expected yield. Okay, this is the most important thing. But this will hide the relevant information about the impact of the project on individual farmers and underlying unrealistic assumptions. Okay. So then second guideline which you have to see is that farm investment analysis should not simply be based on a sample of the farms in the project area. Third guideline, you have to understand farm investment analysis is made usually for the life of the project, maybe 20, 25 years, and not for just 1 year. Okay, some people are in some places, so they used to do 1 year, and the remaining so states, so they are not bothered about it. This is what the lack of coordination or the for the sake of global so relationship which we want to maintain. And thirdly, we have to see that so life of the project is so more than so 20 to 25 years, whether that is there or not. And the farm investment analysis and budget may be prepared for any size of farm. Okay, once so he has proved that so he can prepare so a good amount of knowledge and better than some other people's. The farm investment analysis and budget may be prepared for any sized. In case of female farms, the analysis should particularly be focused on the effect of the project on the total population of the family, of the farm family. Okay. There is a difference between farm family and the so the persons those who are acting as intermediaries or business people or industrialists, so for their family it is different. And so these two things you have to remember. And so there are aspects of the small farm as a finally unit and as a business. And the fifth guideline, what it exactly trying to say is that farm investment analysis should be confirmed the financial worth, while rules of the proposed area in new technology. Okay, so how does this technology is influencing the financial resources and the so market analysis? In the investment analysis, so one should confirm that the financial worthy wellness of the proposed new technology in the project. It must determine the credit requirement to stimulate the adoption of new technology and the risk involved. This is the most important. So when you are trying to invest, so in the form that should always accompanied by the worthwhileness of the project, proposed very new technology in the project. And it must determine the credit requirement to stimulate the adoption of new technology and the risk involved. So these two things are very, very important. Appropriate sensitivity analysis must be carried out. So that is what most important. There are some other guidelines, so which are so having very wide implications. So those things, I'm not going to touch upon now. Then what are the elements of farm investment analysis? Okay, so while doing the project analysis, so this is also one of the most important step. What are the elements of farm investment analysis? Earlier we have been starting discussing about the farm investment analysis. In this, so what are the elements? Accounting convention for farm investment analysis. Okay, what type of accounting convention which is so there, that is the most important. What are the elements which are associated with that? Okay. Accounting convention for farm investment analysis. Accounting itself is a so broad so spectrum of it. Within this, what are the elements which are associated with this? That's what so you have to understand. So first of all, so you have to see that in the farm investment analysis, the principle of discounted cash flow. So that is so to what extent it is been followed. A suitable accounting convention which assumes that every transaction falls at the end of the accounting period is adopted. Unfortunately, so in majority of our developing countries, so though the plan is there and budget so allotments are there, but those budget allotments will reach to the concerned department almost at the end of the account, before accounting the accounting year, hardly not even a month or so. So before the closing of that accounting period, suppose generally in India, so we have the April to March. So this is the so accounting and financial year. So during the beginning of that period only, so immediately the budget is being allocated. So out of that budget, so any type of project can be in a position to think about to what extent so that budget is there, and what type of outputs so which we have produced so far, what else it has to be produced, and these are all the things so which we have to think about it. Though there are some type of conventional methods so which are there, but so nowadays, so if we want to compete, so then it must be dynamic. Okay, so those counting convention process must be dynamic. So then only the farm investment analysis will properly be in taking place, and it is going to be done properly. Then the second aspect which you have to see is the farm resource use. What type of farm resources which you have? Okay, farm resources. So farm means land. So for that, what type of resources which are there to utilize? So the type of availability of these things. Farm resource use means so that farm can be utilized. So for what purpose? What type of crop which is going to take place? What type of output which may likely to arise? So from the type of product, so which is being so used, or which is going to be analyzed, so for that purpose. That is why land use, to what extent, how much land is going to be utilized, so in the process of farm investment analysis. And once the land is being decided to cultivate or to nurture the type of land, to what extent, how much labor force is going to be useful or going to be available to you people. So that is also the most important thing which we have to see: land use and labor use. And third, the second aspect which you have to see, the what is the farm level of production. Because day by day, as we know very well, so we have seen already that day by day the size of holding of the farm is likely to diminish. So as you know very well, in earlier classes I have talked about it. So before 90s, when we are independent India, or at the time of independent or after independent, how these terms which are taking place. Okay. In the farm production point of view, so there are, we have discussed the land use and labor use. Then the crops, for what type of crops the farm is producing. Then livestock, what type of livestock they are feeding their stomach, so while going on this type of projects. And valuation, how much value of the cost is there, which is involved in that. That is most important thing. And the valuation, that also we have to see. So the person who is going to associate with you, what type of valuation which she or he is having. Then incremental residual value. So suppose when the time point of view, if there is a need again, so if the schedule may be rescheduled, so then there is a huge problem. Okay, so that the basic level. Then the third aspect which we have to see is the farm inputs. Farm inputs means, so there are several type of farm inputs which we can see. Investment, operating expenditure, incremental working capital, a note on cost of family labor and cost of land. So in that way, the farm inputs are depending on this type of investment analysis. Operating expenditure, how much it could be. Then incremental working capital. So how much the working capital you are trying to increment, or increment, or you want to grow it. Then a note on cost of family labor and cost of land. Okay, this is a difficult task, but majority of the people are interested. So to analyze that, a note on cost of family member labor and cost of land. So if you have a family labor, then the cost, what is going to happen? Tell me. Okay, cost of family labor. Either a note on, some type of note can be put it up to the cost of land. Yes. Then the farm budget, how you are going to calculate the farm budget. Within that farm budget, what is the net benefit increase? So that is what the most important aspect which you have to remember about it. Net benefit increase. Okay. So the net benefit increase, so basically depending upon present worth of the incremental net benefit after financing the project. Okay, presently how much worth of increment in net benefits after the manage, after the project. Then secondly, present worth of the incremental the net benefit after financing without the project, that can also be taken into consideration, so while deciding the above ones. So then unit activity budget. So for each and every net unit activity, also the budget will be changed. Hmm. Suppose, for example, a fruit plantation, a poultry production unit. Preparation of unit activity budget can also be considered. Unit activity budget means budget that applies only to particular activity. For example, a hectare of first plantation, a poultry production unit, a piggery unit, a dairy herd, and so on. This approach is similar to that of the jarcial building. This approach is very much similar to that of partial budgeting used by the farm management specialists to examine the return to a single activity on the farm, instead of the whole farm when they are working or they are working units, which is incorporated in the cropping pattern of farm invest activities. Unit activity budgets are of special advantage when the project focuses on single crop or livestock or any other production activity which is addition to existing farm activities. So this unit activity budget, so which is going to be more useful and special advantage if you are trying to grow in one project or one crop, so one activity, so which can focus on single crop or livestock or any other production activity which is addition to existing farm activities. Okay, already some type of activities which are existing. So for that, in addition to that, you want to try to produce some other crop then to one crop, so that may be beneficial. Then beyond that, if you add, so then management is going to be a tough task. So that is why, so the returns may likely to come down. So that is why, how to calculate the net benefit increase: the present worth of the incremental net benefit after financing the project divided by present worth of the incremental net benefit after financing without the project, multiplied by 100, whole multiplied by 100. So this is what the formula which we have to apply when you want to calculate the net benefit increase, to what extent it has happened in this year. Present worth of the incremental net benefit after financing the project you have to consider, and present worth of the incremental net benefit after financing without the project. Then those two things, so we can divide. So with that, when multiplied by 100, then the net benefit increase, how much it has taken place, so that is going to be as your result. Then unit activity budget. This unit activity budget we have already discussed. Financial analysis of agriculture business firm. Okay. Oh, then this is the last aspect of it. What is the financial analysis of agribusiness firm? So, financial analysis. So, whenever you are talking about the financial analysis, means, so on the one hand, so assets, on the other hand, liabilities. Both the things, so you have to so balance. That is called, you have to prepare a balance sheet of that any type of firm. Okay, agribusiness firm. Financial analysis means, so you have to prepare what are the type of assets which you have and what are the liabilities which you have. These two things are so balancing with each other, then the agribusiness firm may not have the losses. Otherwise, so if your assets worth is high and the liabilities are low, then benefit so will be increased or benefit will be enhanced. That's what we have discussed earlier. Okay, otherwise, assets value is lower than the liabilities. That means liabilities are more than the assets, then you are going to have some type of losses. So, how you are going to meet that type of losses? So, that is what you have to understand and calculate about it. Balance sheet, which indicates the how equally so you are in a position to maintain the assets as well as the liabilities which that firm or which you are going to have it. Okay, in that, in the assets point of view, you have to measure what are the current assets, what are the fixed assets, and what are the other assets, so which are existing under the assets column. Okay, then in the case of liabilities point of view, current liability, then long term liability, and the overseas equity. Okay, owners so equity, that also very very important. Owners equity means so what type of stake, what type of so budget which has been invested by a farmer in that project, that is the most important input. Then at present, what is the liability? What is the current liability? That means so for that within the panchayat or within that so village level or the household level, we have to see what is the liabilities which are taking place within that. What is the current liability which you have? Then long-term liability, then owner's equity. Okay, in that way, so you have to understand about the liabilities and you have to see the assets, both things put together. So you have to see that whether the assets are more or liabilities are more. So from that way we can try to understand. Then income statement, so this is the most important aspect. So you have to understand day by day, day to day. So what for you are working, what for you are running this firm. So that is for the sake of profit or some type of benefit or the other. So now you have the income statement. While preparing the income statement, so how much revenue is coming, what is the expenses which are so there, then what is the profit out of it. So this is what so when you compare both assets and liabilities, so you can calculate and come with so with this so the what is the revenue which are likely to emerge and what type of expenses which are there, and finally what type of profits so which are likely to come up so to your firm or something else. Then cash flow statement, cash flow statement. So as you know that so cash is so flowing from one place to another place. Okay, so how much, how at what rate the so this is flowing. Then the financial ratios. Within that financial ratio, there are two other ratios which we have to discuss: efficiency rows and inventory rows. Hmm. Okay. Then within that, the income statement point of view, revenue, expenses, profits. So you can calculate and put it. Then cash flow statement. So cash flow, how much cash is flowing. So that also you can have some type of statement on what aspect. So you are likely to spend, how much you are spending on that particular product. What is the cash flow per day and per month. So that also you can put a statement, and you can so try to see incorporate it. Then financial ratios. So these are the important thing which you have to understand. Then efficiency ratio, within that, how much investment you are putting up and what type of returns you are getting, that is the efficiency. Okay. Inventory turnover ratios, that is also an important factor. What type of inventory you are trying to turn over a period of time, that ratio earlier, how much it is there, and this year how much it has been added, and how much you are selling it out. So that is what the inventory turnover ratio which is taking place. Then the formula inventory turnover is, so for example, the cost of goods sold by inventory. Okay. At what rate the goods have been sold, what is the cost of it, then the inventory how much cost, so it has come up. These two things, so one by one, so cost of goods and divided by emission inventory goods. Inventory means not final shape, or within the preparation of a good. So our different type of goods has been prepared, are stocked in some store. Then what type of inventory, which we may call it as the inventory turnover. Inventory turnover is equal to, for example, 2,25,000 is the cost of goods sold, and inventory is 1,67,000. So which means, hardly how much, that is 33 plus 22. This is 553. Only the difference between those two is 1.347 ratio, because inventory turnover ratio, inventory so turnover ratio is 1.347. Cost of goods sold is this much, then inventory is this much. Inventory means already do you have. So then that how much you have, it has been increased and sold out. So the ratio gap between these two things are 1.347 ratio. Then operating ratio. So while doing some type of activity, what type of operating ratio is depending upon operating expenses divided by revenue. Okay, what are the operating expenses which are incurred? Then what type of revenue out of that? So you have got it, which can be multiplied by 100 is equal to operating ratio. This is say as simple as that. Suppose operating expenses are 3 lakhs, then revenue is 3 lakh 50,000 multiplied by 100, then the operating ratio is 85.71%. So that is what, so you can try to calculate and try to, because this must be always positive in your hand. If the operating ratio is so positive, then only you may likely to get some type of profits or benefits. Otherwise, so if it is negative, then you are going to get some type of losses, and so overall, so you may be in a position to lose something. Then income ratios. The income ratios, so income ratio is depending upon return on sales. Okay, so how much return which you are getting while selling your products, okay, that will indicates the income ratio. Okay, suppose return on sales is equal to net income by revenue multiplied by 100. How much net income you have got it out of the revenue multiplied by 100. Okay, for example, so the all mill net income is equal to 40,000. So the as per the operating ratio point of view, the revenue, how much it could be. That is what ultimately the 11.428% is the operating ratio. The operating ratio is very, very small. So that is why the returns on sales is not much good. Then return on assets, that is depending upon operating income by assets multiplied by 100. Okay. So for this purpose, so operating ratio is 80,000, operating income divided by assets worth of 6,97,000 multiplied by 100, that is also 11.477. Then what is the current ratio? Okay. Current ratio is depending upon current assets and current liabilities. Current assets by current liabilities multiplied by 100. So you will get the current ratio, that is 4.66%. Okay, current assets are so very high, then the current liabilities are very marginal. Then so your current ratio, and that means so you are at the positive 4.66%. Then debt equity ratio. This is the most important, how you are going to equate your debt. Excuse me. Yes. Debt equity. Debt means so you have to repay. And so debt equity ratio, which is so mainly depending upon the long term liabilities and long term liabilities plus equity. And equity divided by long term liabilities plus equity. So, in that way, what is the debt equity ratio? Proportion of that long term liabilities have to total debt and equity, and the proportion that equity has in the total debt and equity of the enterprise. So these two things, so you have to decide. So then based on that only you can say that oh, whether you are in a positive or you are in a profit motive, or you are a benefit oriented, or you are a negative, or you are loss oriented. These this debt equity ratio can be decided. Okay, debt and equity. Okay, that is so. If you can see the calculation, this is coming up 0.84. Okay, that means so below 1%. That means the debt equity ratio is 16 to 84%, implying that of the total capitalization in the enterprise, 16% is debt and 84% in equity. There is no good rule of thumb for debt equity ratio. In newly established firms, equity ideally should exceed the debt, but such a conservative rule may not be appropriate in many developing countries where equity capital is scarce. This is what you have to understand. If the enterprise is in the public sector, so with a high proportion of the debt held by public sector agencies, the debt equity ratio may lose some of its importance because of the presumption that if the company fall on hard time, that is the most important thing which you have to understand. Okay. So suppose your enterprise is in the public sector with a high proportion of the debt held by public sector agencies, because there the expenditure is more and the income is very less. So that is why so the public expenditure, the public sector is under heavy debt. Then the debt equity ratio may lose some of its importance because of the presumption that if the company fall on hard time, it will be possible to renegotiate some proportion of the debt held by public agencies. Okay, in that way, so you can understand about this. In agriculture projects, enterprises are likely to need a strong equity base because they process or sell commodities that may sharply fluctuate in price, and that are subject to adverse weather conditions or a fall in productivity. These two things, as we all know, we have discussed earlier also, in agriculture project, these two things are essential, are inevitable. You cannot separate it out, these two factors. One is the weather conditions, adverse weather conditions, and the so at what rate the prices are going to be fixed. The price fixation is not in our hands, or the climatic and weather conditions are not in our hands. That's why, so what any time, any type of thing may likely to happen. Then debt service coverage ratio. Okay. In this, so net income plus depreciation plus interest paid divided by interest paid plus repayment of long term loan. So these two things. So at the top of it, net income plus depreciation plus interest paid, you have to add three elements. And below that, as a numerator and denominator point of view. Denominator point of view, interest paid plus repayment of long term loan. These two things you have to put together, and with the, you can divide, so you can do the division between those two. Then, so the debt service coverage ratio will be 2.92%. So this is what the important thing which you have to understand. Then incremental net benefit, financial rate of return to all resources engaged. That is what, so within the bracket FRRARE. Financial rate of return to all resources engaged. Whatever the resources which you have employed to produce that type of agriculture project, final product. So the ultimately, what is the financial rate of return of all resources which you have engaged? Sum total of the present value of international net benefit before financial stream divided by sum total of present value of total uses of funds. So funds stream, those two things, that by this, so you can put it then with the, so within the formula you can see that INBBF in 1 year, second year, third year, it goes on, number of years, divided by 1 plus I. I is equal to discount rate. Okay. So first year, second year, third year, and goes on in nth year. So how much it is there? And so what is the discount rate which is associated with that? Then what is the life of the project in n years? So you have to understand about it. Based on that, only these things will be emerged. Then financial rate of return to equity. So the FRREBIT, which indicates sum total of the present value of incremental net benefit before income tax stream. So before income tax, so what is the sum total of present value of incremental net benefit? So which you have achieved before the income tax divided by sum total of present value equity stream. Okay. So ultimately, benefit and equity streams. So you are trying to compare. Okay. So these two things, to what extent they are positive, that will be the outcome feature of the financial rate. Then the equity after tax. After tax, before tax we have seen. After tax we can see that sum total of the present value of incremental net benefit after financing and tax divided by sum total of present value of equity stream. So you can compare these two things, then you can decide the financial rate of return to equity after tax. So before tax and after tax, so these two things, how much gap could be there? Then ultimately you can, so trying to consider what type of financial rate of return which has come to the equity after the tax. This is the final factor which is very very important to you, because this is what you are going to have in your hand. The rest of the things, so you have to so pay for them. So before tax means, so some of the tax component which you have to pay for them. So after that only whatever it is remain, so that is going to be your financial rate of return on any type of agriculture project which you are handling, or you are trying to run any type of agriculture project. So these are the major elements which are existing in the agriculture project. So when you are doing some type of financial analysis, so these are all the factors which you have to taking into consideration, and you can calculate these things then. So within the firm, or how an individually, so how these values are going to come, so they will depend, they will decide you whether you are in a benefit stage or in a loss stage, or so whether you are going to get try to, so if you will get good benefits, then you are likely to continue. Whereas but in the case of agriculture, so sometimes it may come benefits, sometimes it may come losses. These are all depending upon, as we have already discussed, in the climatic conditions and weather conditions, and also the inflation rates, so of the prices of the factors of the outputs which you are so producing or utilizing. So at what rate the inflation rate is taking place, so of the inputs which you are applying, so in the agriculture project analysis. So these things, so you have to understand and try to remember about the, so in the case of agriculture project, so if you want to so do some type of agriculture project analysis, these are the important elements which you have to remember. Am I clear to all? This is the today's class.
Thank you very
Okay.
much, Doctor.
Hello.
Hello, Doctor. Thank you very much.
Yeah. Actually, these are all the important elements. So when you have to understand and try to compare these things, if it is an agriculture firm, then equity will come up. Okay, if you are an individual farmer, then so there is no such type of equity, this and that. There is no public sector involvement, this and that. They are not there. You are an individual, so how much you are putting investment, and how much output which is coming, what type of elements, so the cost is, at what rate the elements cost is growing up as compared to the last year, how much marketing you are so doing it, what type of value so which is likely to come to you, then what as you compare with the input costs, what is the output cost, both you can compare, and then you can decide whether you are at the profit stage, or you are in the so benefit stage, or at the loss stage. So you can decide, and so whatever it may be. But so after some time, if you are getting continuously losses, you may likely to shift. Otherwise, so if you are, though the agriculture is inevitable to each and every farmer, sometimes so some farmers they may leave, or they may so try to escape so from the agriculture cultivation, and they may diversify it into some other activity which they may have get some type of benefits or the other, like commercial crops, or some type of agro processed industries. So like that, any type of activity which they may likely to so grab that one, and try to so participate in such type of production activities also. So in that way, so what type of prices which are involved, and how you are going to so do the so farm management costs, and what type of balance sheet which you are going to prepare. So these things, so which are very very important, and prices will be the basic factor, so which can influence the farmer's level of output, how whatever the output which the farmer is having. If the prices are not favorable to him, so or any farmer, then so he may lose its so maximum investment. So that is why so there are several types of prices which has been supported by the government that we have discussed earlier. So these type of things, because the farmers may not be in a position to get so a good number of losses, even though whatever the climatic conditions, whatever the inflation, or whatever the natural calamities which has been taken place, even then the government likely to support so to the farmers, so to a greater extent. In that way the farmers will survive and sustain to cultivate the agriculture crops. So in that way, so this cycle has to goes on and on. Agriculture is not so this time I am going to produce and next time I am not going to produce, like that you may not in a position to come to a conclusion. Whatever the type of output, so whatever the type of prices which are available or which are prevalent, so you should continue to produce so in that type of agriculture land which you have. So that is what so which we can think of it. Okay, friends, so this is what the today's lesson. Okay.
Okay, sir. Content of today is over, sir.
Yeah, content is over. Any questions so or any clarifications, so please welcome.